Very good afternoon, sir. My name is Jinia Banerjee. I am from Govardhana. It is a place located in Kolkata, and I am currently pursuing my bachelor degree in business administration from Brainware University, and I am currently intern at ICAPITAL also. So, sir, today, before I going to start this presentation, I would like to give my consent to iCapital that I hereby grant permission to iCapital and Corporate Advisory LPP to use the video presentation PPT, assessment test and MCQs created and provided by me for educational or promotional purpose. This includes publishing or sharing the content on their social media platforms, websites, or through any other medium they deem appropriate. I confirm that I have no objection to such use. Okay, sir. Now I am going to start my presentation. My presentation, I choose this topic because it is one of the trending topic. Each of every person who did not directly include or actively trade in stock market also can have that kind of interest in this topic. So I choose this topic. The topic name is AI and financial market volatility protecting investors. Moving towards the next slide. I divided this presentation into 10 sections, and each section minimum has 15 slides. Now, I am going to discuss about the first section where I am going to discuss, where I am introduce the topic. Now, the first things is why this topic matter. Why should we even care about this topic? Because I think financial markets are like roller coasters, sometimes thrilling and sometimes scary. One piece of news can make a person a rich and also wipe his all savings within a second. For example, during COVID-19, the stock market crashed in March 2020. Within days, trillions of dollars were lost. People who had invested their retirement money for savings suffered huge losses in this time. Now, what is AI in finance? AI uses smart algorithms to analyze data and make decisions. Like now, AI means what? AI means smart machines or algorithms that can analyze data, learn patterns, and help us to make decisions. In finance, it helps us predict market trends, detect fraud, and suggested safe investments also. Now, the next important topic, which is market volatility. What is this? Volatility means how fast and how much prices of a stock can move in the market. If the prices are jumping up and down quickly, that is called high volatility. And if they move slowly, that is called low volatility. Now, for example, during COVID-19, stock prices were swing widely. This was extremely volatility at that time. Now, why protecting investors is important? When markets are volatile, ordinary investors like you and me are the ones who suffers most. Big institutions have expert teams and advanced software and data models. Retail investors like me don't. They uses like in India, we use this Grow app to help investors protect their stocks. Now, how AI is changing risk management. Traditional risk management was slow and based on human judgment. But AI is like a radar. It detects pattern visible to us. For example, AI can analyze news headlines and tweets to sense panic in the market. It can then warn investors, be careful, risk is hiring. Now, global view of AI in finance. Different regions of the world are adapting different types of AI in different ways also. In the US and Europe, AI is heavily used for trading and fraud detection. In Asia, like especially in our India and China, AI is being used for retail investing apps that reach millions of ordinary people. Now, timeline of AI markets. In 90s, we are mainly use early computer trading system. Now in 2000 century, it's using algorithm trading grew rapidly, which is, and in 2010 we are using mainly AI and machine learning took over. And today AI is everywhere, from mobile apps to billion-dollar hedge funds. We mainly use AI for trading. Why investors struggle without AI? Because the market moves too fast and there's too much data to analyze. Humans also make emotional decisions sometimes, like we panic when prices fall and we get greedy when the price rise. So AI helps us to meet our struggles also. For example, in March 2020, it is a COVID situation. A panic hit. Global stock market crashed. AI-powered funds reacted faster. Those who use AI-powered apps and invested in those funds, they sold risky assets early and moved into safer ones. But like us, uh, like those who don't use that kind of app, they are mainly meet with that kind of market crash easily. So AI is important. Now, key challenges we face, like markets are interconnected globally. One event affect all. We all know that globalization hits all kind of things, not only the trade but also politics, business, and all of. Today's market are more interconnected. We all know. Social media spread news in seconds, making markets even more volatile. For example, one tweet by Elon Musk about Bitcoin can cause the price to rise or fall by 10% in a minute, we can say. But retail investors don't stand a chance unless they have tools to keep up. In this presentation, what we are mainly covers: what drives market volatility, how AI predict and manage risks, how AI helps both small and large investors, and also finally what next for AI in the financial world. Why should we care about this thing? We may be thinking, I don't trade every day, so why does this matter to me? Well, even if you don't check the stock market daily, volatility affects your retirement savings, your insurance plans, it extra. So AI in finance is not just for traders, it affects every working person who has money invested directly or indirectly, we can say. In this section, we mainly discuss about the things that I am going to summarize. AI is no longer optional, it's become essential in finance. Volatility will always exist, but AI can help us manage it better. Most importantly, AI levels the playing field, giving ordinary investors the same protection as big institutions. Now, here is the next section where I'm going to discuss about the understanding financial market volatility. Before we talk about how AI helps, we must understand the real problem, that is volatility. Volatility is one of the biggest challenge in finance. It affects not just traders but in every investors, from small savers to giant institutions. If you don't understand volatility, you can't survive in this financial market. So in this section, I will break down what is volatility, why it happens, and how it impacts us all. Now, what is volatility? Volatility simply measures how much and how fast asset prices moves ups and downs. If a stock, suppose, if a stock goes from rupees 100 to 120 and back to 95 in a short time, that is highly volatility. If it slowly moves from 100 to 103 rupees over a week, then it is called low volatility, which is good for our financial market. Now, why volatility? Oh, I already discussed this in the introduction slide also. So I skip this slide now. Now, why volatility happens? What is the main reason that makes volatility happen in the financial market? It can be a economic events, it can be a political event, it can be a investor behaviors, it can be a global crisis. Like economic events like inflation, interest rate, changes, or job start. In political events like election or wars, and investor behavior like panic selling. Sometimes investor getting panicked and they sell their stock rapidly or hard buying. And pandemics, in global crisis we include natural disasters and pandemics. For example, during the Russia and Ukraine war in 2022, oil and gas prices shoot up worldwide. That single event created volatility in every market. Now, volatility is not high volatility is not good for market. It is right, but volatility always not bad. Why not? Because for traders, big swings mean opportunities to make profits. And for long-term investors, sudden volatility can be dangerous if they panic. Sometimes they get panicked and they sell their stock, which can be rise in future. But they panicked and they sell their stocks. That makes them a significant loss. Now, how volatility impacts people. Now I'm going to discuss how people got panicked for this volatility. Sometimes it can reduce the value of your retirement savings. It can cause many investors to sell at the worst possible time in the lowest price during a crash, which is a which making a huge loss for that investors. It also reduces public confidence sometimes, making people spend less because they think that if I spend that money in that stock, it can be low. It can be if in future the price can be low and I got some significant loss. So that makes them spend less and showing economic growth too. Sometimes they show economic growth also. Now, here is the real life example of volatility. In 1929, the Great Depression wiped out fortunes worldwide. In 2008, the global financial crisis saw market fall 40 to 50%. It is we all know that those who directly uh, joint or directly interact with stocks, they all know that it is Lehman Brothers crisis happening in America in 2008. It is a global financial crisis in that time happened. Now, in 2020, it is a pandemic situation where COVID-19 crash was one of the most fastest, fastest collapse of the market in this time. Now, why it's hard to predict? The toughest part about volatility is that it often comes from unexpected shocks like surprise election outcomes, sudden corporate scandals, wars or political conflicts also. You can't always predict this perfectly, but AI can scan for early warning signs faster than humans, giving investors an edge. Now, what is the volatility index? What is that? Volatility index means market even have a fair meter. That is called the VIX index, which is a high VIX means investors are nervous and markets are likely to swing. Or a low VIX means investors are calm and markets are stable. It almost like a blood pressure check for the market. It tells us whether stress levels are high or low. Now, panic versus opportunity. Volatility affects people differently. Like traders often see it as a chance to make profit. And for regular investors, they usually got panic and sell at losses. For example, when markets fall sharply, professionals are busy buying while ordinary people like you and me are busy selling. Without guidance and panic always wins. We all know that. Now, the role of leverage and derivatives. Some investors use borrowed money called leverages, and this can multiply gains sometimes, but it also multiply losses. For example, if you invest 1 lakh with 1 lakh borrowed and the market falls by 10%, you don't just lost 10,000 rupees, you lost 20,000. Now, similarly, complex products called derivatives can add to the problem. They can trigger forced sales, making volatility spiral out of control. Now, the panic cycle. What is the panic cycle? Volatility creates this panic cycle. Like bad news sometimes spread quickly through TV and social media, and people get scared and sell their holdings, and prices fall even faster. More people panic and sell again. If this continue happening in the market, the price of the stock significantly low. Now, how it affects small investors. Big financial institutions have expert teams, better AI featured apps, and advanced models. And small investors usually have one of these, not all. So, when volatility hits, big players stay prepared, while small investors are left confused and end up selling at a loss. It's so we can say that it mainly affects small investors. Now, here I'm going to discuss why small investors suffers most. Small investors are especially vulnerable with high price or low price because they don't have AI tools, they make emotional decisions, they sell during crashes and missing the recovery. Meanwhile, professionals buy cheap. They buy mainly in that crash moment and make huge profit in the future. Now, what we learn from history? History also teaches us something important. What is that? But it market always recover. It teaches us the most important thing that market, if they got crashed, it also recovered in the future. But if you panic and sell at the bottom, you don't benefit from the recovery of the market. That's why smart tools like AI-driven alerts and models are so important. They help investors survive the storm instead of jumping off the ship. Now, need for smart tools. Today's market reacts instantly to global events. Social media can create panic in just minutes. Traditional analysis is too slow. So, AI changes this by processing data in real time, sending alerts immediately, even rebalancing portfolios automatically. This gives retail investors a fighting chance against unpredictable volatility. Now, in this section, what I am discussed already, now I am going to summarize these things. To we discuss volatility. What is volatility? It happens. Why it is happens? Because of economic, political, and psychological factors. It hurts mainly small investors more than large institutions. And most importantly, AI is now essential for handling volatility because it reacts faster and protect portfolios from panic-driven losses. Now, moving towards the next section, which is role of AI in finance. Now, AI has completely reshaped modern finance. It is completely reshaped our modern finance. How? Think about how finance used to work. Brokers shooting on trading floors, people manually studying charts and decisions taking hours. And now, with AI, traders can be executed in milliseconds, billions of data points can be processed instantly, and risk can be detected before they explode. Now, moving towards the next slide. Now, role of AI in modern finance, which is the role of AI is not just for big institutions anymore. It is helping both banks and ordinary investors now make smarter, faster, and safer decisions for all in today's generation. Now, types of AI in finance. Now, I am going to discuss about the different types of AI in finance. First one is machine learning. It helps us to learn patterns in stock prices, predict trends also. Now, deep learning. It uses neural networks to make complex forecasts. Now, natural language processing, which is read news, tweets, and reports to understand market sentiment. And the last one is robotics or RPA, which is automates repetitive tasks like compliance and reporting. Now, moving towards the next slide, AI in trading. Trading is where AI shows its real power nowadays. AI-driven trading systems can execute trades in microseconds, detect, it helps to detect hidden opportunities in charts, analyze global news instantly, which for human takes more than hour, and analyze, most importantly, avoid emotional mistakes that is mainly happened by people. Now, AI in portfolio management. Managing a portfolio is like balancing a diet. Too much for one thing is risky. Like AI helps by rebalancing portfolios automatically during volatility. Now, protecting capitals by shifting money to safer asset when needed. Helping small investors through robo-advisors and helping institutions with advanced AI models for complex portfolios management. For example, robo-advisors like Wealthfront or Betterment adjust your investments automatically based on your goals without you lifting a finger. Now, moving towards the next slide. Here I am going to discuss about the predictive analytics in finance. What is this? One of AI's biggest strengths is forecasting. It looks at historical data, economic signals, newses, and even social media settlement to predict risks early and trends also. This means investors can get early warnings. This reduce emotional last minute decisions also, helps improve long term returns also. Now, here is the robo advisors for retail investors. Here I am going to discuss about the impact of robo advisors for the retail investors. For small investors, AI-powered robo-advisors are game changers. Like they manage portfolios at very low cost, they diversify investments automatically, and they protect people from panic-driven mistakes also. Now, here I am going to discuss about the difference between AI and human being decision making. AI's decision-making process is fast, accurate, data-driven, and free of emotion. They not get easily panicked or they have no emotion. We can say that. And humans, they bring judgment. They easily got panicked. They sometimes bring ethics and their ability to handle rare events also. The best result comes when we combine both. AI provides speed and insights, and human provide wisdom and control. It's like it makes trading decisions more proficient. Now, how AI handles big data? How? Everyday financial market, we all know, generate billions of data points. Stock prices, traders, newses, tweet, it extra. AI helps us to process this huge data quickly, filter out noises means irrelevant data, and also highlight only the useful insights and spot the risk before others can. So those who use in today's generation AI powered apps for their investment decision, they get most benefit. Now, AI trading cycles. What is this? The first one, here I am going to discuss about how AI trading cycle works. First one is collecting data from markets, from newspaper, from social sentiment, etc. Now, the next one, they start detecting the patterns and trends, and then they generate whether they buy or sell the stock, and then execute the trades automatically and adjust portfolio to manage risk and mainly to keep risks low. So basically, it doesn't just help in decision making. It can take care of the whole cycle from analysis to execution. Now, AI tools in action. Here, I am going to discuss about some real-world tools include. First one is robo-advisors, which is mainly individual investors. Algorithm trading dashboards for professionals. And market sentiment platforms that track news and social media. These tools can make complex financial strategies simple, accessible, even for people who are not experts also. Now, here are the risks of over-reliance on AI. In the previous slide, I discussed about the advantages of using AI featured apps. But here I'm going to discuss about the risk of over-reliance on AI. What is Sometimes it may fall during rare and extreme events. If you continuously use AI, you notice sometimes that they making same mistakes again. They provide repetitive tasks or text. So it is very risky for investors too much reliance on AI, or it sometimes mainly relies on too much past data. They don't sometimes focus on the present data. And sometimes it's black box, decision cannot be explained. They only give us the decision, but they don't discuss about that. In fact, too much reliance on AI can even increase volatility because algorithms react very fast and sometimes all in the same way. Now, here I'm going to discuss about the human oversight. Now, I'm already discussed about the disadvantages of over reliance on AI, and that's why human monitoring is critical. Regular audits, testing, manual controls ensure AI doesn't go out of control. It helps us to make our decisions stable. Human at the final judgment, especially in unusual situations where AI may not able to make decisions. So human sometimes able to understand the bigger picture in the unusual situation. So it is very important to also depend on the human oversight. Now, here I am going to discuss about a real world example of hedge fund success, which is there. Now I am going to describe. During the Brexit vote in 2016, many investors panicked, but several hedge funds using AI scanned global news and sentiment data. They quickly moved money into safer assets and protecting themselves from huge losses. Firms relying on traditional methods suffered most in this time. This shows how AI can act as an early warning system when chaos breaks out. Now, how AI has transformed finance. Now, it helps us to make decisions proactive, not reactive. Portfolios are now automated. Risks are can easily detected now, and both small and big investors are getting benefited for this AI transform finance. In this section now, what I already discussed. Now I'm going to wrap up this section, which is AI improves trading, portfolio management, and risk protection. It levels the playing field for retail investors, but it works best when combined with human oversight because technology should guide us, not replace us. Now, here I am going to discuss about the fourth section where I mainly discussed about AI prediction and mitigate market volatility. Now, introduction of this section. We all know that markets are unpredictable by nature. A sudden political decisions, a natural disasters, and also an economic event can cause market crash. The problem with traditional system is they react after the damage has already been done. By then, many investors have already lost money already. And AI changes this game by predict volatility early, by analyzing massive data, send alerts to investors so they can act before it's too late or before it happened already the market before already the market crash. Now, forecasting volatility. How can we forecast? How can AI forecast? How does AI actually forecast volatility? How the things they do, it scans multiple layers of information at once, such as price and trading trends, unusual patterns in the market. Now, news and global events, political, economic, or social triggers, they also analyze. And historical comparison. Sometimes they compare the today's situation with the past crisis. It helps investors to act before the storm hits. It's like having an early warning radar in financial market. Now, data sources used by AI. Here I am going to discuss about where AI mainly collect data. Now, the first one is market price histories and trading volumes. Next one is economic indicators, which include GDP, inflation rates, then interest rates. It is mainly included in the micro uh, economic factors. Now, social media sentiment and breaking news. Also, they collect from that source the data. This 360-degree view gives AI the ability to spot risks that human would miss sometimes, or they sometimes ignore that kind of data that AI helps to collect from this all kind of source. For example, suppose if thousands of tweets suddenly show fear about a company, AI can detect it instantly. It helps to detect the things or the main reason for the sudden fear instantly before the stock prices start falling. Now, machine learning models. Now I'm going to discuss about the machine learning models, which is mainly AI predicted. These models do study past volatility events, detect unusual signals that humans may miss sometimes, and keep learning as new data comes in. This makes prediction adaptive, just like a doctor who gets better with more experiences, and AI models improve as they processes more real-world events. Now, sentiment analysis. What is this? Markets are not driven by numbers alone. They are driven by emotions, fears, greed, and confidence. Move market just as much as earning reports. It is called the sentiment analysis mainly. AI uses natural language processing (NLP) to scan news articles, financial reports, and social media posts. If fear is rising, suppose if fear is rising in the market, even before prices move, AI can detect it early. For example, we can say that the early days of COVID-19, people started posting panic tweets about lockdowns. AI picked up on this fear about before May investors understood what was coming. Now, early warning alerts. One of the best thing AI does is act as a risk radar. When volatility indicators spike, AI sends real-time alerts to investors. Here I am going to discuss these things with an example, which is suppose imagine your phone buzzing with a message. Market risk rising, move to safer assets. This gives people time to rebalance their portfolios instead of panicking at the last moment because they get the alert before it actually happens. So, now moving towards the next slide. Volatility hedging tools. Traditionally, when we markets are got too risky, people simply sold everything. But AI helps nowadays us manage risk monitor instead of existing completely. AI suggests shifting money to safe assets like golds or bonds, diversifying into multiple sectors, and using hedge options that protect against crashes sometimes. Now, here I'm going to discuss this topic with a real world case study. In May 2010, the US market experienced a flash crash. Prices dropped nearly 1,000 points in minutes because of high frequency trading. The reason is high frequency trading. Since then, exchanges have adopted AI-driven circuit breaks. These systems automatically pause trading when market falls too sharply. During the COVID-19 crash in 2020, these AI safeguards were triggered multiple times. They helped slow down the panic, calm volatility, and protect investors from deeper losses. This shows how AI can prevent chain reactions that once caused disaster before the AI powered finance apps. Now, automated risk management means when risk rise, AI can sell risky stocks immediately, moves funds into safer assets like bonds and defensive stocks, and rebalance portfolio without human delays. For example, while a human investor might take hours or days to decide, AI can act in seconds and keeping portfolio aligned with risk preferences. They manage the portfolio with which is aligned with the risk. Now, here I am going to discuss about the AI risk management type, which is AI in risk management system. What is the first thing happen? First, they mainly detect the risk. Then they analyze the risk by collecting data from 360-degree sources. Then they evaluate and the data and make decisions. And Also, they verify the decisions, and also after execute the decision, they monitor whether this good for the market or not. Now, here I am going to compare the traditional versus AI methods. As I already discussed this, but here I am just give you a small recap, which is traditional risk management is more slow. It is depend manually, and it is reactive, not proactive. And in AI driven risk management, it is mainly data based and real time and proactive. It is not reactive. It is often in traditional risk management, it often acts after the losses already occurred in the market, and AI driven gives us early alert about the risk, and we can instantly make us move our money in the safe assets. Now, impact on small investors. How this impact on small investors? AI tools like robo advisors, alerts, automated rebalancing, not just for billion-dollar hedge funds anymore. Small investors now can easily access these apps. This reduces the knowledge gap between professionals and ordinary people. It's like giving every retail investors their own personal financial assistant. Now, market stability benefits. What is the benefit markets have during the stabilization? Like when AI acts quickly, it helps calm market as a whole. It reduces panic selling, it smooths price swings, it improves overall confidence of the investors. When investors feel protected, they are less likely to make rash and quick selling, emotional decisions also. This benefits not just individuals but the entire financial systems. Now, here are the challenges in prediction. Of course, AI is not perfect. Not all time perfect, but sometimes it is perfect. But I think in future, with using more data sources, more algorithms, it's going to be better. For that, to make this AI more perfect, it requires some important things. Which one is models need constant update, as I already told. Rare events like pandemics can still cause chaos that is happening. We can't ignore that thing. And human oversight is always needed for judgment in extreme scenarios, because AI can't detect that kind of big picture of the market. So AI helps to reduce risks, but it can't completely eliminate them, just reduce them. So think of it like no. Now, now I'm going to wrap up this section, which is first we discuss AI predict volatility before it happens, provide real time alerts also, protect both small and big investors, help the market maintain the market stability, and still requires human oversight and constant improvement, because AI is good, but AI is not always perfect for protectively managing market storms before they hit. Now, here is the next section, which is the risks of AI in volatile markets. Till now, we have seen how AI can protect investors and manage volatility. But let's discuss something new, which is because AI itself can also create new risks also, which is just like a powerful medicine can have side effects. We all know. AI in finance can cause same damage if if it is misused or poorly designed or sometimes left without proper protocols. In this section, I will talk about main risk, real world cases, case studies, and solutions to keep AI safe in volatile markets. Now, algorithm trading and flash crashes. One of the biggest risks in algorithm trading, AI systems can place thousands of traders per second. This sounds efficient or more good, but during high volatility, this speed can make market collapse suddenly. A famous example for that I'm going to discuss about in the 2010 flash crash in the US, where the stock market fell nearly 1000 points in just a few minutes, caused mainly a automated algorithm reacting to each other. So, while AI makes trading fast, sometimes it can make it too fast, creating chain reactions that humans can't stop in time. Now, data bias leading to bad prediction. Another danger is bad data. AI learns from only past data, but what if that data is biased and incomplete or wrong? For example, for discuss this thing more clearly, I am going to discuss about with an example. If an AI system is trained only on good economic years, and it may completely it's for if the AI system is mainly trained on the good economic years, it may fall during the crisis. So we say that if the data is flawed, the prediction will also be flawed. So we should be care during the training of the, we should take to care of us during the training of the AI, during this kind of decision making. Now, overfitting and false confidence. AI can also fall into a trap called overfitting. This means what? This means it learns patterns from history too perfectly, assuming they will always repeat. But markets, we all know that, always don't always follow the past. When something new happens, AI can't easily predict that kind of forecast. These wrong forecasts give sometimes so they always think that the market repeats, so sometimes they make wrong forecast which give investors false confidence also. They feel safe and take more risks, and they just have they got a significant loss for this reason. Now, cyber security risk. AI systems themselves can be attacked. Hackers, we all know, as the in today's generation AI is now increase. Also, the risk of cyber security also increases. Like hackers could easily hack them and put sometimes they include the false data into an AI system that cause wrong forecast for that AI app. So they could, so cybersecurity is very critical in protecting AI-driven market. So we also have some. We also need so much secure our app which we are using to make financial decisions. Now, AI amplifying hard behavior, which means sometimes AI makes volatility worse instead of calming it. Why? Because many algorithms react in the same way at the same time. For example, if one AI decides to sell, others might copy the same signals, creating a domino effect. This herd behavior makes markets spiral down faster than they should. So, AI can unintentionally add fuel to the fire. So that make the market more volatile sometimes. Now, regulatory concerns regarding AI. Regulators like SEBI in India and the SEC in the US are worried about these risks that is related to AI powered finance apps risks. High frequency trading, data misuse, algorithms, hidden algorithms, we can say, sometimes cross into market manipulation. That's why regulators are demanding more transparency and explainable AI. Sometimes AI can't explain the decision that they give us by analyzing the past data. So they want more explainable AI. Meaning means firms must clearly show how their algorithms make decisions. Without regulations, AI could make market unfair, giving big firms advantages while small investors suffers most. So, SEBI want more transparency and explainable AI for making important finance decisions. Now, here I am going to discuss about a case study, which is Night Capital, that is happened in 2012. This is one of the most dramatic example of AI going wrong. In 2012, Night Capital, a large US trading firm, had a software glitch. For that, within just 45 minutes, the system placed millions of unintended trades. Result: what happened then? The firm lost $440 million and almost went bankrupt. This shows that one small error in uncontrolled AI system can cause catastrophic losses. Now, here is the positive feedback loop. AI systems can also create positive feedback loops. How? That doesn't mean something good. It means a self-reinforcing cycle. Self-reinforcing cycles. Here, how it works. First, one AI sells a stock, others detect the drop and sells too, and prices fall further, trigger more sellings. This loop accelerates market crashes instead of calming volatility. So AI sometimes speeds it up. Now, investors' over reliance on AI. Another risk that is happened, which is blind trust in AI. Many investors think if AI said it must be right or it is true. But AI, it is not magic. It it can fail during rare events or pandemic situation. Overconfidence in AI makes people unprepared for unexpected shocks and make a huge loss for them. Now, how to mitigate human oversight? So, how do we reduce these risks? By using human oversight. Traders and risk managers must monitor AI systems, conduct regular audits and testing, have skill switches to stop trading if things go wrong. So, human must always remain in control. They keep the control of the apps. So, AI is the assistant, not the boss. So, AI don't go out of the trend. Now, mitigation. What is it? Is diversified AI models. Second, don't rely on just one AI system. Second thing that you should don't rely on just in one AI system. Firms should use multiple AI models and cross-check their prediction. This way, if one model fails, others can balance it out. So this helps to save their money also. Now, the third mitigation is circuit breakers. Third, how now exchange now use circuit breakers. Automatic pause when price move too fiercely. This act like emergencies brakes on a car. Means they stop panic driven chain reaction, give time to breathe, and prevent chaos from spreading. AI driven circuit breakers have already been used in events like the 2020 COVID-19 crash. Now, the next one is mitigation, which is strong cyber security. Strong cyber security is a must, and AI system must be protected with encryption, real-time monitoring, and constant audits. If hackers manipulate AI systems, the entire market would be at risk. So, just as we build firewalls for banks, we need firewalls for AI too to mitigate the risk of the hackers. Now, here I'm going to wrap up this section. What we discuss? We discuss AI brings speed and efficiency, but it also creates new damages. Leaks include flash crashes, data bias, herd behavior, over-reliance, and cybersecurity threats. The solution what? Human oversight, diversified AI system, circuit breakers, and strong regulation. This way, AI remains a shield for investors, not a threat. Now, moving towards the next section, which is protecting retail investors. Now, till now, we have seen how AI can predict risks, also the damages it brings. But the real question is, what about small investors? Retail investors, ordinary people. Retail investors are the ordinary people investing their savings mainly, are usually the ones who suffer most during market volatility. They don't have the speed, tools, knowledge of big institutions. And in this section, we are going to discuss about how AI can level the playing field and give retail investors the same kind of protection that billion-dollar funds enjoy. Now, why small investors or retail investors are vulnerable? Small investors face disadvantages like they have limited knowledge about complex markets, slow access to information, emotional decisions because they got panicked easily. For example, during a crash, retail investors usually sell out of fear, while professionals buy cheaply. That's why AI is important. It gives retail investors speed, insights, automated decision support, which reduce this gap. Now moving towards the next slide. Robo advisors as safety nets. One of the most helpful tools for retail investors is the robo advisors. It automates portfolio management, diversifies holdings, and rebalances automatically during volatility. Most importantly, robo advisors prevent emotional mistakes like panic selling. For example, during COVID-19, robo advisors help many investors avoid selling at the bottom, saving them from huge losses. Now, AI powered diversification. Diversification is the golden rule of investing. Never put all your eggs in one. Never put all your money in one stock. AI makes diversification smarter by spreading investment across, like stocks, bonds, gold, even alternative assets also. This reduces the impact of a crash in any one market. It's like it helps keep the profit stable. Now, real-time volatility alerts. With now, what is this? AI-driven platforms also provide instant alerts. How? Like market, they just uh, send you a market risk rising alert, considering to shifting to safer assets. This alert allows small investors to act early, just like professional traders. Without such alerts, retail investors often react late and suffer losses. Now, behavioral nudges. AI can also act like a financial coach. It detects emotional patterns like panic selling or impulsive buying and sends reminders to stay focused on long term goals. For example, an app might say, "Don't panic, your portfolio is designed for long term growth." This simple nudge helps investors avoid costly mistakes by selling their stocks in a bottom price. Now, educational tools with AI. AI is not just about managing money, it's also about teaching. We use chat GPTs for our education purpose. Chatbots and stimulators can explain financial basics interactively. Suppose if you search something that you don't know, any term, it helps us easily understand that thing anywhere, anytime. It is a self-paced learning. For beginners, this is like having a personal tutor. We can say that I already told. 24/7 hours, we can easily access it. So, when investors understand risks and diversification better, they make fewer decisions. Now, regulatory protections, SEBI and SEC. Regulators also play a big role in protecting retail investors. For example, SEBI in India requires robo-advisors to clearly explain risks, and the SEC in the US demand transparency from AI-driven platforms. These rules ensure retail investors are not misled by hidden algorithms or unfair tools. Now, AI as risk insurance. Some fintech platforms are going even further. They use AI to create loss protection features. It works almost like insurance. Suppose if markets fall too sharply, these AI tools automatically cap your losses. This way, small investors can stay invested without a fear of losing everything. Now, here is the real life example. During the 2020 crash, means it is the COVID-19 situation. Many people panicked and sold their investment, but those using robo-advisors were protected. Data shows that robo-advisors users preserved 15 to 20% more capital compared to manual investors. This is the proof that AI can really save small investors in tough situations. Here is the checklist of AI protection. To make the best use of AI, retail investors look for platforms that provide diversified portfolios, real-time alerts, behavioral nudges, then regulatory compliance and optional risk insurance features. This checklist ensures you are not blindly trusting AI. You are using it wisely. Challenges to adoption. There are some challenges. Many small investors don't trust AI. Some don't know how to use these tools. And some of them are not till now are not aware of this kind of tools. Others worry about transparency. So that's why educational campaign and user-friendly platforms are needed to build confidence and increase adoption within this kind of small investors. Here is the banks and brokers role. Banks and brokers have a key role to play in this market. They can bring AI-driven services to small towns and cities, Tier 2 and Tier 3 areas like in our area, making financial protection accessible to middle income groups easily. They can do. This democratizes investing. So it's not just a wealthy who benefit. They just make the benefit among all kind of people. They help to get benefited from that. Now, future. Personalized AI advisors. What is the future? Looking in the future, if we will see that every small investors could soon have a personalized AI advisors. It will help monitor portfolios in real time, suggest trades, automatically protect your money during crisis. And in the near future, ordinary people will enjoy the same advantages as professional trader till now get. Now, Now I wrap up the section. What we are already discussed. We discussed more, that first one is small investors are vulnerable in volatile markets, but AI tools like robo-advisors, alerts, nudges, and diversification protect them. With proper education and regulation, AI can reduce the gap between retail investors and big institutions also. Now, moving towards the next section, here is the institutional investors and AI. This section explores how AI helps institutions run efficiently, protect their portfolios, and even stabilize market during crisis. Now, hedge funds and high frequency trading. Hedge funds are often the first to adapt new technology. With AI, they use high frequency trading HFT, executing thousands of traders per second. This helps them to profit from teeny price differences that humans would never notice. But the downside of this, if not carefully control that, this can add short-term volatility to market also. So, while AI boosts hedge fund profits, it can also can cause the downfall of the market if all algorithm rush in the same direction or repeat the task without noticing on the present situation. Now, risk management for pensions and mutual funds. Pension funds and mutual funds are different. Their focus is only safety and long-term growth, we all know, since they manage people's retirement savings. How AI help in that situation? They continuously monitoring portfolios. They helps identify risk early. They adjusting holding automatically during downturns. In this way, even when markets are falling, people's retirement funds are shielded from the worst impact, or they get the shield from the market fluctuation. Now, AI driven stress training. One of the smartest use of AI is in testing. AI can stimulate events like a market crash, a war, or a sudden economic shock. By running these stimulations, institutions can see how their portfolios would respond and prepare contingency strategies. It uh, this stress uh, helps to protect from market crashes, economic shocks, and geopolitical crises. ESG, or environmental, social, and governance investing. In today, investors are not just looking for profits, they also care about sustainability. AI helps funds analyze environment, social, and governance data. For example, it can scan sustainability reports, news, and even satellite images to judge whether a company is eco-friendly or not. This way, large funds can invest responsibly while also meeting investors' demand for ethical portfolios. Now, moving towards the next slide. Here is the case study. BlackRock's AI Insight. Now let's talk about this thing. The world largest asset manager. They use AI to analyze global economic trends, detect risks early, and optimize asset allocation. This helps us a competitive edge. They can balance risk and growth for millions of clients better than traditional methods alone. Now, sovereign wealth funds. Government run investment funds called sovereign wealth funds also rely on AI. These funds protect national wealth, often worth hundreds of billions. AI helps them track global markets, detect risks early, allocate money efficiently. This ensures countries can protect their citizens' wealth even during downturns. Now, institutions as market stabilizers. One interesting thing about large institutions is they sometimes act as market stabilizers. During panic driven sell offs, institutions often buy assets when prices are low. Now, the question in your mind, why? Why they buy? Because their AI systems tell them the fundamentals are still strong. This not only benefits them but also calms the market for everyone else. So they buy the purchase the stocks. Now, liquidity management with AI. Institutions also need to manage liquidity. Keeping enough cash available to meet withdrawals or obligations. AI ensures that don't have to sell investment at a loss just to raise cash. This reduces forced selling, which could otherwise destabilize market further. Now, collaboration with regulators. Large institutions, as I already discussed, their regulations like SEBI in India and SEC in US, together they build fair AI trading practices. This corporation is important because it prevents misuse of AI while encouraging innovation. When institution and regulators work hand in hand, market stays safer and more transparent. Now, advantages over retail investors. Institutions have clear advantages over small investors. They can easily access to advanced AI systems, huge amounts of data, and expert analysis. This gives them a big chance. But this also raises ethical questions. Should they use this age to exploit small investors, or should they create a fairer market? That's why regulations and ethics are important or need to be followed. Now, risk for institutions. Even the biggest funds are not invisible. A single software error, biased model, or hack can lead to massive losses, sometimes affecting the entire financial systems also. So that's why institutions always need backup systems, diversified models, and human oversight. Now, lesson what we learned from the events during Brexit 2016. Institutions that combine AI with human judgment avoid major losses. During COVID-19, those who trusted only AI models faced challenges. This lesson helps us to follow the best strategy, that is hybrid AI speed plus human wisdom. Now, emerging technologies. AI itself is evolving or continuous changing. When combined with blockchain and quantum computing, the possibilities are enormous. Faster and more secure transactions, even more predictions, accurate predictions, and revolutionary changes in institutional finance. Now, here is the summary of this section. AI helps institutions manage trillions of dollars efficiently. It protects retirement fund, support sustainable investing and stabilizing the market. Even big players need human oversight and diversify the systems. Now, moving towards the next section, which is regulatory framework. AI is transforming finance, but with great power comes great responsibility. We all know. If it is left unregulated, AI could create unfair market fraud or even crashes and make wrong decisions, which can cause a huge or significant loss in the market. So, strong regulations are very much important. This section explores how government regulators, governments, regulators, and global organizations are making sure AI in finance is safe, transparent, and fair. Now, global regulation overview. Region like European Union introduced the EU AI Act, which demands that AI system in finance must be transparent, as I already discussed in the previous slides. And in the US, the SEC has guidelines to ensure AI tools in trading are fair, not manipulative. It helps to build trust by making sure AI doesn't harm markets by following these rules. Now, India's AI and finance rules. Now, I am going to discuss about the India's finance and AI rules. In India, our regulatory SEBI and RBI have taken early steps. They require AI-driven platforms disclose their risks, strong cybersecurity standards, and transparency about how algorithms make decisions. This helps in India balancing the innovation and safety also. Now, regulatory sandbox. Acha. One smart idea is that the use of regulatory sandboxes. Why? Because it is like a safe playground where fintech companies can test new AI systems under the regulatory supervision before launching them publicly. That's why it is a good idea. Innovation is encouraged, but risks are controlled. It helps us to control the risk also. Now, ethical AI guidelines. What are the guidelines AI must follow? AI must be fair and unbiased. Decision must be explainable. No hidden discrimination should occur. Now, real world penalties and cases. Regulation in the US and Europe, several trading firms have been fined heavily for unfair algorithm trading and data misuse. These cases prove that enforcement is active. It sends a strong message us that if you misuse AI, you will pay the price. That prevent the misuse of AI and ensure the safely use of AI tools for make important financial decisions. Now, here is the data privacy and investor rights. It is one of the critical area. AI systems handle sensitive financial data, we all know. So they must follow strict laws. The GDPR that is in Europe and Digital Data Protection Act in India. Violation can result if anyone violate that can cause huge penalties and loss of trust. So protecting investors' data is just as important as managing market risks. Now, international corporation. Markets are global, so regulations also need global corporations. That's why groups like the G20, Bank for International Settlements are working to create common AI standards. This ensures that cross-border trading remains safe and fair. Now, visual timeline of key regulations. Here I am discuss about the real world scenario. Like in 2018, GDPR introduced strong data privacy rules. In 2020, SEBI issued guidelines on AI use in India. In 2023, European Union passed the AI Act and ongoing global standards are being discussed by G20 and others. This timeline shows that regulators are moving quickly to keep up with AI. Now, why regulation is necessary? Because without regulation, AI could manipulate market, exploit small investors, or trigger large-scale crashes. Regulation helps to set boundaries so innovation can happen without destroying trust or stability. Now, balancing innovation and safety. The biggest challenge for regulators is balance. Too much restriction would kill innovation, we all know, and too little restriction could cause huge damage. That's why flexible approach like sandboxes are important. They allow growth while still ensuring safety. Now, challenges in regulating AI. What are the challenges? The first one is AI evolves faster than laws can keep up. Many AI models are black boxes, hard to audit, and new tech like quantum driven trading is even harder to monitor. So, regulations also must constantly update their rules and learn alongside technology. They keep up to date all the time. Role of financial institutions. Regulators can't do everything alone. Banks, brokers, asset managers must also self-regulated because regulators are not can't handle all these things alone. They also adopting ethical AI standards, regular audits, strong cyber security. If financial firms regulate themselves well, they avoid legal trouble and build more trust with customers. Now, risk without regulation. What happens if we don't regulate AI? Flash crashes could become frequent. Fraud and manipulation could spread, and investors could collapse. Without regulation, AI could destabilize entire the economy. So, oversight is not optional. Human oversight is essential along with AI. Now, what we are discussing in this section, we discuss effective regulations ensures AI is a tool for stability, fairness, and innovation. With global cooperation, ethical standards, and constant oversight, AI can safely transform finance. Without regulation, AI would become a danger instead of a shield. Now, moving towards the next, which is the future of AI in volatility management. AI is still evolving, we all know. By 2035, we may see completely new way of managing risks, powered by quantum computing, blockchain, and self-learning systems. In this section, we will explore the future of AI and how it could make financial markets safer, faster, and more inclusive. Moving towards the next slide, next generation AI with quantum computing. Quantum computing is the next big step. While normal computers analyze data step by step, quantum computing analyzes millions of possibilities at once. When combined with AI, this will allow real-time analysis of complex data, prediction of volatility with near instant accuracy, faster risk detection than anything we have seen before. Personalized AI advisors for all. Today, only the wealthy can afford personal financial advisors, but in the near future, every investor could have a personal AI advisors on their phone. This will help them monitor their portfolio 24/7 hours, forecast risks, automatically rebalance investment, give strategies on reserved only for professionals. Now, decentralized finance. Another big trend is decentralized finance. It uses blockchain to create borderless bank-free financial system. Now, AI integrated with DeFi make automated investing without banks, global, trustless, and transparent platforms. Anyone, anywhere can invest and manage risks. This could open financial markets to millions who currently have no access to banks or advisors. Now, self-learning AI risk managers. Future AI system will not just follow old models, they will learn continuously. They will adapt instantly to new shocks, adjust to market crashes in real time, update their strategies without human intervention. This makes them more like living systems constantly evolving to protect investors better. Now, blockchain plus AI for transparency. One of the biggest criticism of AI today is that it is a black box. But if combined with blockchain, every decision and trade can be recorded transparently. This means investors and regulators can audit AI actions in real time. Future scenario year 2035. In this time, AI predict risks weeks in advance. Portfolios adjust automatically. Large-scale crashes are prevented before they begin. Instead of chaos and panic, markets run smoother and more stable. This is the vision many experts believe is possible if AI and regulation grow together. Job stimulation in the financial sector or job impacts. AI will also change jobs in finance. How? Routine roles like junior analyst and manual traders may disappear, but new job will grow in AI oversight, cybersecurity, ethics, and system design. So, while some roles vanish, some others will be created. The finance industry will not shrink, it will evolve. Retail investors benefits. The biggest winners in this future could be small investors. AI will give them access to automated hedging, personalized strategies, low cost risk protection, making ordinary investors as powerful as large institutions. Now, here are the opportunities for startups. Fintech startups will also benefit. They can create AI-powered robo-advisors, make sentiment trackers, and blockchain AI tools. Since the demand for automation is growing, startups that innovate early could become tomorrow's financial giant, just like Paytm, Robinhood grew rapidly in recent years. Now, global financial inclusion. One of the most interesting impact is financial inclusion. AI-powered Devi and robo-advisors could help millions of people in developing countries access investment tools for the first time. This bridges the gap between the rich and poor nations, giving everyone a fair chance to protect and grow their wealth. Now, the ethical and regulatory system. As AI grows, global regulators will also evolve. We may soon see uniform international rules for AI in finance. This ensures that no matter where you invest, in India, US, or Africa, the same ethical standards and protection applies all. Now, Vision 2030 Safe Market. Experts believe AI could reduce panic-driven crashes, give equal access to rich tools, make financial system faster, fairer, and more resilient. Now, inspirational outlook. To conclude this section, the future of AI in finance is about empowerment and safety. It's not just about making profits. It's about ensuring every investor, big or small, can navigate market confidently. AI is moving us towards a world where finance is smarter, safer, and more inclusion. Now, I am going to wrap up the section. Here we discuss AI will combine speed, personalization, transparency, and decentralization. Quantum computing blockchain will take prediction to a new level. Retail investors and startups will benefit massively in the near future, and regulators will ensure fairness and trust. Moving towards the next slide. Now I'm going to discuss about the last and final section for my presentation, which is the conclusion and takeaways. So, after this long journey, let's bring it all together. Here are the key takeaways. AI improves forecasting, portfolio automation, risk protection. It works best when combined with human oversight and strong regulation. Most importantly, AI reduces panic-driven crashes and makes market more stable. In short, we can say that AI is not just a tool, it's becoming a shield for investors. Balancing benefits and risk. AI is powerful, but like all powerful things, it has two sides. First one is benefit, second one is risks. Benefits are incredible speed, data-driven insights, and cost efficiency. And risks are the flash crashes, bias in data, cyber threats, and over-reliance. What is the solution for that? We must use transparent AI tools, conduct regular audit, rely on multiple systems. This help us that's why or this will help us to manage or balance the benefit and risk. And AI strengthens the market instead of weakening it by balancing both the benefit and risk. How investors stay safe? How they stay safe? How can what can we do as an investors? Prefer regulated AI tools that is preferred by SEBI, SEC, and European Union. Now, keep your portfolio diversified. Don't depend on only one asset. Combine AI alerts with human oversight and make balanced decisions. Depends on both. Call to action. Here is my call to action for everyone. Educate yourself about AI powered financial tools. Diversify your investment and review them regularly or monitor them regularly. Support ethical, transparent, and regulated AI practices because the future of finance is not just about profit, it's about safety, fairness, equal opportunity. And here is the final message and references. My final message is simple. AI should act as a shield, not a threat, when guided by human wisdom. This helps us to learn that technology alone is never enough. It needs responsibility, ethics, and human value to truly serve society. Here are the references where I am taking my information that I am writing here. I taking the information from European Union AI Act 2023, SEBI circulars, rules on algorithm trading and AI tools in India, US SEC guidance on AI in finance. It is also in 2023, and BlackRock and BIS reports. These sources confirm that AI in finance is not just theory, it's a global reality. They also ensure that my information that I have used in my PPT, it is true. Thank you, sir. Thank you, everyone.